Happy Friday, everybody. My name is David Ratti with the Ratti lending team at Envoy Mortgage here in Annapolis, Maryland. I wanted to do a mortgage minute to update everybody on the state of the mortgage market. To steal a line from the Hunger Games, we live in interesting times. The first thing I wanted to share about the mortgage market is mortgage rates are not 0%. The Fed reduced the overnight lending rate, which is the shortest of short-term rates, to 0%, to 0.25%. Mortgages are the longest of long-term rates, and sometimes that can have an adverse impact on mortgage rates. But again, we live in interesting times, and COVID was on nobody's business plan in January. So we have a lot of external factors that are impacting the mortgage market. First, most people do realize that we've seen maximum volatility in the financial markets. We've seen that in a very short period of time. It has some elements of what occurred back in 2008. That happened maybe over a year's time. This happened over 3 weeks. Nobody was really prepared for this. It caught a lot of people off guard, and there's a lot of misinformation out there. And some of the information isn't misinformation, but maybe dated information. So a little bit of background about mortgage lending and the impact this has had on mortgage lending. And when I say this, I mean the COVID pandemic. The financial markets are running for cover, which means they're hoarding cash. People are nervous about their investments. And when they get nervous about their investments, they withdraw, much like you and I do, and they hoard cash. The second thing that has happened is with the stay-at-home orders, a lot of businesses have had to close. A lot of people have been furloughed, lost their jobs. So there are some predictions that we're going to see 20 to 35% unemployment. This is not lost on investors and investors in mortgage banking. What that translates in the mortgage world is 20 to 35%. That's 1 out of 3 people, which means maybe 1 out of 3 households may not be able to make their house payments. This has caused a lot of volatility in the mortgage markets. To complicate that further, if you look at February and the beginning of March, we had historic low mortgage rates. The demand for mortgages increased 4-fold in that 30-day period before the pandemic panic. So we have this huge demand for mortgage loans. And now with the pandemic, we have investors who are withdrawing from interest in mortgage loans. And this is why. If 1 in 3 are not able to make their mortgage payment, these mortgage servicers still have to make the payments to the investors, the end investors. In addition to that, the number of forbearance claims will skyrocket, which means they have additional expense in managing their business. So like any other business, they have stepped aside and lost an appetite for mortgage loans. And this has caused major disruption in the mortgage industry. The first is there's been a flight to quality, a significant flight to quality, which means any risk elements or additional risk elements that are attached to the mortgage loan have no market. There's no interest in the investment community in additional risk. There's an entire segment of the mortgage industry that has been wiped out over the past 3 weeks. Most people aren't even aware of that. It's alternative financing. We call it in the industry non-QM. These would be loans for self-employed people where income was verified by looking at their bank statements as opposed to their tax returns. This would be recent credit events, somebody who maybe had a bankruptcy or foreclosure in the near term as opposed to 7 years ago. These would be unusual properties, maybe unusual condominiums. That entire segment of the market has been completely wiped out. almost overnight. It's gone. So even people that had loans in process, that market's gone. The other part of the market that's been significantly impacted is what we call jumbo financing. So these would be loans that are not eligible for FHA or Fannie Mae or Freddie Mac, which are all federally backed programs. These are private investment loans, large banks, investment houses, and so forth. They have tightened up. They're not interested in additional risk. So we've seen a lot of the jumbo players come out and say, if you want to refinance your home to reduce your payment and you have really good credit, no problem. We still have that there for you. But if you want additional cash back, like walk away with $50,000 or $100,000, they're not interested in that. So rate and term refi in the jumbo market, still accessible, still very affordable. But on the jumbo side, you're seeing a pullback of the added risk elements. Cash out is a risk element. On the government loan side, this is mainstream government loan side, a lot of first-time home buyers, second-time home buyers, so forth, especially when you're talking about FHA and VA loans. There's been significant and dramatic changes in that market. The added risk elements are credit scores, loans with maybe where you buy a property with more than one unit, any additional risk elements when you add that on top. The investment mortgage industry has completely lost interest in those loans. It wasn't but a week ago, the minimum credit score for an FHA loan was 580 for most lenders. Today, it's 640 in a week. So it took a week, and some lenders changed on Monday, some on Tuesday, some on Thursday, but pretty much the entire industry now is 640. Some lenders are 660 for FHA. It's had a dramatic impact on what's going on with the market. So that being said, I always, one of my favorite quotes is opportunity out of adversity. Let's look at what's right with the mortgage market and what's good. Mortgage rates are still really good if you keep in mind quality is what investors are looking for. So what that means is for borrowers that have good credit scores, good reserves, a lot of equity in their home, those quality features will still bring them the best rates. So if, for example, somebody is looking to refinance their home and they meet those criteria, their rates are still fantastic, probably somewhere in the threes, could be low threes, high threes, depending on their circumstance. That opportunity is there. Purchasing a home, this is a unique opportunity. So the opportunity out of adversity in this is that a lot of buyers and sellers have stepped back. It was very competitive for buyers in the marketplace. On any given day, you might see a home for sale that would have 3 offers, multiple bids for the home, and they'd be competing for it. Well, that has sort of that has definitely changed because of the stay-at-home orders. Now, real estate, mortgage lending, title services, those are considered essential services because it's shelter. So we are not closed. Our industries are not closed, but obviously people are weary about walking through homes. So virtual tours, the industry is adapting to that. We implemented e-closings to minimize risk and exposure for our clients. Some in the industry are doing that as well. But you may not have as much competition in putting an offer on a home today that you may have faced 3, 4, or 5 weeks ago. So there may be an opportunity there as well. The other thing I wanted to bring to your attention is that there's an age-old adage in the mortgage business, and your grandparents told your parents told you that you want a loan with no points. And in historically low interest rate environments, that makes sense. We're not anywhere near normal. So what has happened is, remember we talked about hoarding of cash and that the investment community is only interested in quality. Well, investors are not interested in paying money up front to acquire a mortgage in order to gain a return over time that might be a little greater. So for example, if interest rates are 3.5 with no points, there has been the option in the past where you may choose to take 4%, a higher rate, in return for maybe $5,000 or $6,000 in cash at closing. Those are called lender credits. That has changed. Investors are not interested in funding money up front to buy an asset, the mortgage, where maybe 1 in 3 people won't be sending in payments. So what we've seen is a changing of the spreads. So the easiest way for me to put this is that as the rates go lower, you're getting much more value. So if rates are, for example, at 3.5, in the past, if you paid a point, which is 1% of the loan amount, so let's say it's a $300,000 loan. In the past, if you paid $3,000 up front instead of 3.5, you would get 3.25. Today, you may get 3 or 2 3/4 because cash is king. If you're willing to have a premium rate by buying that rate down, there's significant value in that segment of the market right now. Contrary or opposite of that, if you're looking at above par pricing, meaning above 0 points to get money at closing to help buy a home, those spreads aren't there. So when we look at risk factors on loans, one thing to keep in mind is that risk factors have what we call add-ons to mortgage loans. Typically, lenders will put that into the rate so you can get a 0 point rate. For example, if you're an investor, there might be a 2-point add-on. That 2-point add-on could be absorbed in rate. Instead of giving you 3.5, give you 4 or 4.25. That doesn't exist today. If you're an investor buying a loan, you're going to pay points up front. There's just no way to bake it in the rate because investors are not paying above market front money for above market pricing. So I don't want to get too far in the weeds, but let's just, as a summary, point out where the value is. Number one, buying down interest rates is good. There's a lot of value, significant value we haven't seen in years. I've been in the business for 30 years. The rate that you will get by buying down your rate is significantly better than any time I've ever seen. Number two, keep in mind that lenders are looking for above 640 credit scores. There are ways that we can rescore people to get them up there. And those opportunities are available with your loan officer. So that being said, that's the latest update for the mortgage industry for today, April 3rd. And what I'd like to do is suggest that you take that to heart when you're looking at mortgage loans and understand mortgage rates are not 0, but they are really good. I mean, they're still in the 3s for most people, depending on your circumstance. If you have any questions, you can reach out to me at www.rattylending.com, or you can call me and I can review your situation with you to help you take advantage of the opportunities that are readily available in this marketplace. The best way to get a hold of me would be through my cell phone, 410-707-5825. And again, you can email me at DRATTI at envoymortgage.com. So I appreciate everybody tuning in. For more information, definitely hit my website, www.rattylending.com. Hopefully it's on the screen. I should have started with this, but look, when it comes to mortgages, I'm all in. When it comes to live broadcasts, not exactly an expert on that, so I hope you bear with me. I look forward to talking with you, hearing any questions you may have, and I'd love to share them on our next broadcast. Thanks a lot. Thanks for joining us, and until next time, stay safe. We'll talk to you soon.